Hi, in this week's video, I just want to talk to you about how to make sure you never lose money with your property investing. And the key to never losing money is to ensure that you always buy correctly in the first place. So many investors trip or fall into property investing. They may move house and keep their old house and rent it out, or they may think that investing is a good thing and they go buy their first one without getting any real education. And so many of those investors are the ones that will either have the horror stories as a worst case, or they'll share some stories of pain. And those stories of pain have come because they've bought incorrectly to start with. They've not come because property investing is hard work or a bad thing. So the key is to know your rules. If you speak to any professional investor, somebody with 50 plus properties, whatever type of property they invest in, they'll be crystal clear on what the rules are. What are the rules that allow me to purchase a property? What are the rules that stop me from purchasing a property and say, don't go ahead with this? So I want to teach you in this video the rules for investing in family-let properties. Okay? If you're going to buy a family-let property, you're kind of safe, secure, standard model, the model that's been around for quite a number of years, what are the rules that you should use to guarantee that you never lose money from buying that property? Okay? And there's really 5 key rules plus a bonus one which I'll go through. So the first rule for me is to only ever buy 3 or 4 bedroom houses. So don't buy 1 or 2 bedroom houses, and don't buy flats and apartments. Now, why do I say that? Because in 1 and 2 bedroom houses or flats and apartments, you get transiency. You get a situation where people move in, then they meet a new partner, a boyfriend, girlfriend, and they want to move on and move out and live with them. And each time you have turnover in a property, it costs you money. You might have a great bond, you might have had a great tenant, but there'll be some bits of maintenance, wear and tear, that the previous tenant would have lived with, but the new tenant wants changing. There'll be a period of empty. It could be a week, it could be 5 weeks, period of empty. There'll be a letting agent fees to pay, or if not, your time to put into it to get the property let again. And the average turnover of a property costs about £1,500 for a family let. That's on average. Okay? So you don't want to be in that situation where your property turns over every year or two, because over 10 years it's going to cost you thousands of pounds more than a property where the same tenant stays long term. So for me, it's 3 or 4 bedroom properties every single time. And these are houses, and you want the best yields, I'll come on to that, but these are houses. They might be town centre terrace, they might be a semi-detached, or an ex-council house. I'll come on to why in a second with that. The second key rule to follow, okay, is to ensure that you buy the best property for the best return on investment. Now, what do I mean by this? If you're looking to have a job in property, if you want to have your own job in property, then you want to buy your properties relatively local to you, because you need to be able to go visit, you need to be able to go manage them yourself, because it's your job. Okay? You don't want a job that's 200 miles away. However, if you're choosing to be a property investor, and by the way, so many people set out to be a property investor, that's what they say they want to do. They've got busy lives already, busy family, busy work. That's how they've got successful and got some money together. And then they end up with another job because they get into property, but they may be quite frugal or quite tight, and they don't want to spend money on other people, so they want to do it themselves. Then you're not an investor. Okay, you might have an element of investing in there, but you've got a job. You've got a property job. Okay? So a pure investor puts money in to get a return out. So when I invest, I want the best return on investment. If that property is 100 miles away, but it gives me a far better return than the property that's on my doorstep, I want to leverage other people's time and experience, and I want to buy the property that's 100 miles away. Because if that's going to give me a better return, I'd far rather have that better return. I'd far rather have that money in my pocket from a better investment return. So think about that. Think about investing in the right areas to get the best returns. The third rule is to buy for asset growth. Okay? You want your properties to be going up in value. On average, in the last 80 years alone, the UK market has gone up at 7.9% a year. And funnily enough, they've just announced the figures over the last year. And they're saying that they've gone up 7.9% in the last year as well. So over time they go up 7.9%. To guarantee good capital growth, which 7.9% is, you need to follow 4 basic concepts. It's as simple as that. Buy in a town or a city, close to a great school, good public transport network, good road network. If you tick those 4 boxes, your property in the UK over time will always get good capital growth. The 4th rule is to make sure that you buy for cash flow as well, because you want it to go up in the future, but you want your cash flow to be protected in the meantime. Okay? So in terms of cash flow, you need to make sure that the property you're buying, you take account of all the factors. So you've got your rent coming in, but you need to knock off the mortgage cost. And don't forecast the mortgage based on today's great rates. You need to forecast the mortgage based on the rates having gone up 3 or 4%. What would it then look like? If then it would still look cash flow positive, great. Okay? So that's the mortgage. You then, and what we do, by the way, we normally forecast based on the best 5-year fixed at the moment, because that's a great indication of what the next 6 or 7 years are going to be. So we might forecast based on a rate currently of about 4.5%, because it gives us a good feel. But then we'll stress test it even a couple of percent higher than that. We won't take a 5-year deal, but we stress test on that basis to make sure that it will always be affordable. We then add in maintenance. We know an average 3-4 bedroom family that costs £1,000 a year. That's £85 a month. We add in the cost of insurance. We add in the cost of a letting agent. Whether I'm going to manage it myself or not, one day I might be ill for 3 years. One day I might want to go travelling and have some financial freedom. I need to be able to afford a letting agent on this property. And when you take all those costs off, it needs to still have positive cash flow. The more the better, obviously, but there needs to be enough positive cash flow there that if it was empty for a month that year, that the extra cash flow in the other 11 months would pay for the empty month. Because then you know this property will never ever cost you money again. You're never going to have to go in your pocket to put any more money into this investment property because you've budgeted for everything and it's still cash flow positive. The majority of novice investors that get into cash flow negative positions and they gamble on the asset growth get themselves in a lot of trouble when the market slows. The 5th rule that you have in place is to ensure high occupancy. And you ensure high occupancy by making sure that you run an advert to rent your property before you've actually bought it. So you agree to buy it, the next day there's an advert in the local paper, or you've maybe placed it on Zoopla, and you wait to see how many responses you get. And the advert will be something like 3-bedroom house, every street, you know the name of the road, every street, double glazing, gas central heating, £150 a week, bonds and reference required, call this number. And when people call you up, you'll say, I'm really sorry, that property is not available just yet, but it will be in a few weeks. Are you interested? Yes, I am. Great, you take their name and number. You need a minimum of 10 replies in the first week, otherwise you shouldn't go forward with the investment. Now, why do I say this? Because if 20 people reply, 10 people view it, 5 people want it, then you can ask for bank statements, wage slips, references, you can ask for the whole gambit. And you'll be able to choose a tenant. But if 5 people reply, 3 people view it, 1 person wants it, you're now in a position where you haven't got to choose the tenant. They've chosen you. Okay, imagine in life choosing your spouse like that. You're going to live with this tenant for many years. They're going to be in your property for many years, hopefully. Imagine choosing your spouse like that. Well, this one person was interested, so I took them and I live with them for the next 20 years. In fact, some people do that, unfortunately, and very sadly, but the majority of us wouldn't like to choose our spouse in that way. And you shouldn't choose your tenants in that way, but too many landlords are forced to because they haven't listened to this rule and they don't follow it. So I don't care if I've got a 40,000 discount and it looks like it'll cash flow at £300 a month and I'm not having to put much money in. If it doesn't meet this rule, I'm still walking away. Okay. Now, if you follow these rules rigorously, along with the bonus one I'm going to give you, it will lead to you rejecting 59 out of 60 deals even though they arrive with a 20% discount. Because that's what we do at the Insight Group. We reject 59 out of 60 deals, even though they arrive with a 20% discount. And that's the bonus rule, by the way. You must always, always buy property at discount. It triples your financial returns over a 10-year period. If you put two people side by side, they buy identical properties, get identical tenants, manage them in identical ways, but this person buys with 15% plus discount and this person buys with no discount, and you look at their situation in 10 years' time, this person will have triple the amount of property that this person will have and triple the amount of financial returns that this person will. So imagine if this one's making 15 grand a year, this one's making £45,000 a year. If this one's making 30,000 a year, this one's making 90,000 a year. A year, not just for 1 year, year after year after year. Triple the results consecutively for the rest of their lives because they learned to buy at discount. You must learn to buy at discount and action buying at discount. I really wish you the best with your property investing. Invest with knowledge, invest with confidence, create financial freedom. Thank you.